Hello and welcome from me, Philip Nothard and Curtis Hutchinson to this special Motor Trade Radio podcast brought to you in association with eBay Motors Group. So many thanks again for joining us in the latest in our series of special interviews themed around sharing best practices for car retailers as they continue through their way to manage the COVID-19 crisis. Previous interviews are still available with people such as the Suzuki boss Dale Wyatt, Mitsubishi MD Rob Lindley, Marshall Motors, Dash Gupta, Cap HPI's Devon Martin and Clive Brooks of Clive Brook Volvo, and many more are still available to stream online from Apple and Google Podcasts, Spotify, SoundCloud and Deezer.
Well, today we're delighted to welcome our special guest, Adrian Dally, Head of Motor Finance at the Finance and Leasing Association. So welcome to the show, Adrian.
Good morning, Curtis. Good to hear you.
Yeah, and you. Great to have you on. Now, regular listeners to the Motor Trade Radio podcast will be familiar with our monthly look at the FLA finance figures for new and used car sales, which we'll look at in a moment. But before we do, Adrian, can you just give listeners a brief backgrounder on the FLA and what your role is regarding motor finance?
Yes, the Finance and Leasing Association, which is what FLA stands for, is the trade association that represents finance and leasing companies throughout the UK, and those finance and leasing companies that provide services to both business and consumers. And in this context, that includes the motor finance providers, whether they're the captive finance providers that work with the manufacturers, or the independent ones that often finance used car sales. So they're all in our membership, and collectively this matters because 94% of new car sales are backed by finance provided by an FLA member. So that's who we are, and that's our background, and that's how we sit in with the work the dealers do.
So, I mean, welcome, Adrian, and eventually we've managed to get you on the show, and obviously we do speak on a regular basis, so fantastic, and welcome to the show. So we've obviously there's lots to cover, obviously with what's been happening in that finance sector, and and the best practice, the best place, should I say, is probably to start with the FLA's recently published figures covering June. And the month dealership started to obviously reopen, albeit staggered through the UK, and obviously what's been happening in the first half of 2020.
Well, indeed, the figures recently out for June show two particular things, not exactly the same, and dealers will have been noticing this quite considerably, I think. The good news is that the volume of used car finance has gone up by 2% compared to June the previous year, which is probably the best way to look at it. On the other hand, the volume of new car finance has gone down by 21% compared with the same month last year, June last year. So looking at things positively, you could say that there has been a pretty sharp V-shaped recovery for used car sales, given that that the track for finance follows the track for the cars themselves. As the finance is the ancillary product, so you've had a strong V shape there, indeed a bit of growth compared to last year. Not quite the same for new cars yet, 21% down on this time last year, or 79% up from the base in the heart of lockdown. You could look at positively. So not a complete recovery yet, but there's obviously been challenges in the wider supply chain that go towards that. But yes, that's for June. I think in the heart of lockdown, if you were told before June that that's how June was going to pan out, I think you'd probably be fairly pleased overall.
And as you say, from those figures, we can see that the recovery in June was led by used car finance demand. What's your expectation for July? Because I guess that's very much the key month, isn't it? Because that's the first full month of dealers being open across the UK following the lockdown. And we know that new car registrations increased by 11.2%, which was we also know was powered by retail demand. So how do you see the July figures panning out?
Well, early indications are pretty positive, actually. There's obviously been some speculation as to whether the strong June we saw was all about pent-up demand, and therefore there'll be a dip, especially with September coming. However, we haven't really seen that yet. I mean, obviously, not all the data's in, so not yet a full picture, but it's certainly looking at the more positive end of the spectrum. Used car market remains strong, and I expect to see some good numbers there as well. But as you say, in July and August, new car volumes and therefore new car finance volumes tend to have a bit of a dip before September. It's not looking quite like that, I have to say, but a week is a long time in many things. But it's certainly looking reasonably positive. And of course, there's been breaks in the supply chain during lockdown as factories closed, which then shift the timing of new car acquisitions as well. And there's certainly an element of that going on. But it's looking more positive than we thought it did. That's for sure.
And as you say, Adrian, I mean, obviously June was really the first month since lockdown and really the first clear month. But July, now we've got sort of Scotland and Wales fully on board for the full month, and will give us a full clearer picture. But I mean, what's your take on demand for finance and what is likely to pan out over the sort of the coming months? I mean, especially as we're now coming away from the furlough support from the government. We're in that reduced stages now, and we're actually on a regular basis through the consumer sector we're seeing increases in job losses. So what's your take on that and around consumer debt and the demand for finance?
Well, it's a very interesting situation, and the commentators always say that no two recessions are the same, and it'd be churlish not to acknowledge that we are in recession now, and therefore clearly that has an effect on pretty much all markets, including the automotive one and the finance sector that supports it. So clearly there's going to be effects across the board, as in any recession. However, one of the characteristics of this one is that it's in some respects quite polarizing compared to previous recessions, where yes, there is a percentage of the population that could increase significantly as the furlough schemes end, who are very, very adversely affected by the COVID situation. Much more deeply than in other recessions, perhaps. And that's a matter of grave concern. And clearly, finance companies have been providing a very significant level of forbearance to those customers over recent months through what's often called payment holidays, or what we prefer to call payment deferrals. So very significant impacts there. But for the rest of the population, 80% plus, the situation hasn't been quite so stark as in previous recessions. Indeed, the savings rates have gone up for that population on average, and for many of the 80% of the population, their financial position may actually be better. So it's a complex market. How this pans out post end of furlough and when the government support schemes start being rolled back, we don't know. Is the honest answer. But it is a fairly polarized situation there. But it's a more complex one than in typical recessions. But certainly, as finance companies, clearly we've had our moral, social, and economic obligation to provide support to customers who have been adversely affected by the crisis, and indeed those that will be affected in the future as well. That does mean a significant loss of income in terms of the support we're providing in terms of forbearance. But clearly, just like the motor trade generally, for a number of weeks, effectively the motor finance sector closed down as well. There was no new lending going on because there were no car acquisitions going on. And from a lender's point of view, if there's no lending, that means no future income from your loans. And therefore, there is potentially something we're concerned about, which is over the medium term, the impact of the forbearance we've been providing does impact your cash position as a lender. The defaults that inevitably arise will affect that too. The loss of future income from the lockdown will have an impact over the medium term, and potentially issues like residual value fluctuations could have an impact as well on the profitability of loans. This is not to provide a scare story, but it does significantly change the cash flow for lenders over the medium term. We've obviously been in very close talks with the government and the regulators about this going forward, where clearly, as the economy recovers, it's very important that finance companies are there to provide support in terms of lending and other forms of finance to businesses and consumers to acquire assets, including cars. Very important that we remain there and able to lend. And I'm confident that will be the case. We will be there as a finance sector to support dealers over the medium term. But that doesn't happen automatically, and there will be challenges along the way.
And just before we move on to Curtis, just in terms of, this week in the Times there was an announcement that the British Business Bank has extended deadline for their business loan schemes, and that's sort of the medium size and larger businesses for the extension. Do you think there is possibility? You're saying you're in conversations with the government, and do you think things could still change around that sort of support for the motor finance sector in general, or consumer loan sector?
Well, the government is saying today that there will be an announcement on the future of those support schemes next month, and we take that to mean that they are considering options, including extension of the support schemes, and that's something we would certainly favour. Pulling the plug on support in too black and white a way could have negative effects in a very significant way. So we are asking the government to continue to provide support over a longer period to support the recovery going forward, and that reflects the position that the finance sector has to play, because without finance to support acquisition of assets, whether you're a business or a consumer, then that part of the economy doesn't grow, and that really matters. And one further aspect that we're obviously conscious of is that if you look at the data on the impacts of COVID on different parts of the economy, clearly hospitality in all its forms was by far the worst affected, but the next level down, the three A's were the ones affected most: aviation, aerospace, and automotive. And so we do expect the government to recognise that, because these are all areas, automotive in particular, supports employment in every single town across the four nations of the UK. And that's really important that this sector remains viable and vibrant and can continue to support customers and businesses through the recovery and beyond.
Yeah. Now, Adrian, the other big story impacting car dealers really came to the fore last month when the Financial Conduct Authority formally banned the discretionary commission model for car dealers. And we know that will start from the end of January 2021, which is good news for the sector because it does give everyone time to prepare for that. Now, the FLA was involved in the consultation process, which I believe started back in October last year. Can you tell us how receptive the FCA was to the dealer model, which is unusual from other models in terms of selling finance, and how does the FLA feel about the ban?
Well, in terms of the ban itself, we very much welcome it. It's something we've been arguing for a long time, and let's be honest, what's being banned is something that's effectively stopped already and has been in transition out of for many years. So it's a very positive move. It gives parameters to the market, creates a level playing field. So undoubtedly, this is good for the players in the market, and ultimately very good for its customers. So pleased to see it's over the line. Also very pleased to see that the FCA listened to us in terms of the challenges in implementing the new model at a time of the COVID crisis. So they've given us extra time on that, which is a very good move. And now we've got clear certainty around which to plan for the future. But in terms of the position of dealerships, absolutely, I think the FCA has always had its eyes wide open on how the industry works. At the end of the day, when it comes to car finance, the vast majority of cars have to come through a physical place, a dealership, and that's where the vast majority of customers engage with both the vehicle and with the finance. That is just the way it is. Okay, the market is growing more diverse, but that's far numerically the biggest part of the market. And there are plenty of other ways in which financial services are provided in that kind of model. So the issue is not whether finance should be provided this way. It's more a recognition of the fact that this is the prime way of providing the finance, and how can that be done in a way that's continuously improving. So that's absolutely goes with the grain of where the FCA are going. There's been initiatives for a long time that dealers have strongly embraced, like the SAF, or Specialist Automotive Finance Program, which is about constantly raising standards and giving dealers the tools to confidently and safely sell finance and continue to do so. FCA think very highly of those industry initiatives and are giving us the encouragement to develop those. So to be honest, I think the way I would look at it is that actually the FCA hasn't rolled out many new rules on commission. There's only a few lines of them ultimately that are coming into force. If there were genuine problems in the sector, you'd expect there to be hundreds of new rules coming in to regulate it. But that's not what the FCA has done. They've given us a fair set of parameters around commissions that the industry has embraced, and that's a good outcome. And beyond that, we're good to go. This is a sector that's had a huge amount of development over the years, continues to do so, and I would certainly say to dealers that they can be confident that they're going to get the support from finance companies to continue to sell cars backed by finance, and that's a critical part of the UK economy, and there is no ultimate challenge to that.
And from what you say, Adrian, it does sound as though the FCA were receptive. It was a genuine consultation process. They were listening to what the FLA and other interested parties were saying.
Absolutely. We've got a very strong relationship with the FCA, very open and transparent with them, as do the dealers. And it's a part of the financial services sector that's right out there in the open. There's no secrets about how it operates. It's transparent. And also it's a sector that has been in constant improvement over the years and will continue to do so, just like all competitive parts of any market in the economy. And I think that's the key thing. I think the thing that a regulator like the FCA looks at is very much, is this a sector that's competitive? And is the competition working well in the interests of the sector's customers? And I think if you look at the trail of the FCA's work on motor finance over the last 6 years, it's given the industry a very good bill of health in those areas where, as dealers know, this is a highly competitive sector. Dealerships and manufacturers and dealer finance companies are competing for customers. And ultimately that works well in the interest of the customer. They're the ultimate winners out of this. And I think that's the FCA's ultimate objective here, is to keep that market as competitive, innovative, and where the way it operates is hardwired towards continuous improvement, like all good industries are. And I think and that's the industry that I see, and that's the industry I'm proud to represent.
I mean, in terms of the ban and around this, but I mean, PCH, personal contract hire, has been a subject of discussion, debate over the years, obviously around regulation of it and things like this. And we know that, it is increasing its percentage penetration as OEMs enter that space and work with the retail network. But I believe it's exempt from the ban. And what did you make of that? And will it encourage some sales to sort of move and more focus more on PCH, or do you think there's something else behind the PCH element of it?
Well, we expected the FCA to do what they did. There are technical reasons why the FCA was not able to extend the discretionary commission ban to PCH, and that's because their original analysis didn't cover PCH, so they didn't have the evidential basis to extend the ban to it, because that's fair justice in the sense that if you're going to roll out a ban on anything, you've got to have the evidence on which to do it, and as it didn't look at PCH, the evidence isn't there. So the discretionary commission ban doesn't apply to PCH, but the key point the FCA have emphasised is that the other FCA rules and principles do apply to PCH, and that includes the principle of treating customers fairly and acting with integrity. So it's not as if there's a vacuum here. So what the FCA has said is that although the narrowly the ban doesn't apply to PCH. If nevertheless operators were selling PCH unfairly in terms of their commissions, then that's still a breach of the FCA's rules. It's still not treating customers fairly, and operators can still expect enforcement action if there's unfairness. And that is the way it is. So it's not as if there's a vacuum here. But that said, this PCH, as you say, is a growing part of the market, and that reflects a long-standing cultural trend as customers move away from ownership of assets towards usership, and that trend will undoubtedly continue, and therefore PCH style models will continue to grow. So it's certainly an area of regulatory focus by the FCA. And I think the key point for the industry here is whether you're providing hire or lease or selling it in dealerships. Ultimately, fairness is the watchword. As long as what you're doing is fair to the customer, it's priced fairly, it's sold fairly, and the right products are lined up to the right customers in terms of their needs, then you're good to go. And that's the issue, really. Is PCH or indeed PCP or HP, is that the right product for this customer? What are their demands and needs? That's the issue. So the industry has a menu of products for all types of consumer. I think the job for dealers in particular is to ensure the customer in front of them is lined up with a product that meets their needs, whatever that product is.
Just as a follow-up to that, Adrian, do you think the FCA will keep tabs on PCH sales, and if PCH sales do go up, they will start to review whether or not they need to take a closer look?
Yes, that's what the FCA said they would do. They said they'd keep a watching brief on not just PCH, but also other areas of the industry where discretionary commission models have existed. For example, premium finance, asset finance. They'll be looking at that, as they always do. And the FCA will always look at where products are increasing in popularity, because they know that, to be fair, 9 times out of 10, if a financial product increases in popularity, it's for a very good reason, because the market needs it, customers want it, and it's a good product. But 1 time out of 10, it might be for other reasons that the FCA needs to fix. So that is the way a modern regulator operates and needs to operate. So they clearly will be looking at this, but to be fair, there is nothing intrinsically wrong with PCH. It's the right product for an increasing percentage of customers. It exists for a reason, and the issue is are PCH and PCP and HP, for example, are they being offered to the right customers in terms of their needs? That's what matters. If customers' needs change, then take up a product change. So increasing PCH is not of itself an issue.
As long as it's sold the correct way to the right customers that require it, and that's the correct product for them as a customer, isn't it?
Exactly. I think the lens through which the FCA looks at a lot of these things is, was there a good conversation? Was there good interaction with the customer? Were they given very clear information about the product in order to enable the customer to make the right decision about what's the right product for them? And I think that's where, for example, the SAF initiative is really about giving the dealership staff the tools to have that really good quality conversation, whether that's in person or online with customers, to enable ultimately our industry to do the right job, which is to give customers the right products.
And just before we move on to Curtis's final question, but in terms of the dealer as a sector, in terms of because some of this is about paperwork, isn't it, and having that trail of conversation and demonstrate that. Do you think the majority of the retail sector are up to speed with that regulation and adherence to policies that they need to have, or do you think there's some work to do on the back of the recent announcement?
Well, I think, to be fair, I think the industry has embraced these changes and is strongly moving in the right direction. And I think, to be honest, I think the COVID crisis has, if anything, increased the pace of that, actually, as all types of businesses concluding that you've got to be really safe in the way you do things. You've got to be secure. You've got to reduce your risks in order to provide a sustainable business. So the direction of travel is overwhelmingly positive on this. That said, I think it'd be fair to say that probably the larger dealerships have had the capacity to embrace the change quicker than smaller and medium-sized ones. So, for example, take-up of SAF has been faster amongst the bigger dealerships, and so the focus for us at the FLA is to work with medium and smaller-sized dealerships to increase the take-up of things like SAF to enable them to grow in the future. So there's always work in progress, but I think across all dealership types, the direction of travel is exactly the same. All businesses are moving in that direction, and our job at the FLA is to support all those businesses and ensure they, whatever their size or market, they've got the tools they need in order to support sales and sell finance well.
And final question for you, Adrian. As we head into the September plate change, we know there won't be a scrappage scheme, even though there were calls for one. What do you see as the challenges and opportunities facing dealers selling finance? And also, do you expect to see heightened captive finance support programs from the car makers?
Well, obviously, the market is evolving pretty rapidly, and I think we can all be confident that the captive and independent finance providers will be wanting to give dealers as much support as they can, subject to the resources they themselves have available at that time, which is obviously something we're working on and hoping that we get the appropriate support from government to do. So yes, I mean, there will always be a strong will to provide dealers with the support and the incentives that they need to move the metal, as it were. In the long term, though, taking a long-term view, something that we know government, indeed governments all over the Western world are interested in, is the transition to low carbon. Whenever that transition, whatever that target is. So there may or may not be a scrappage scheme in a classic sense of the word, but I think it's pretty much certain that there will be support for that transition to low carbon in some way, and ensuring that support is rolled out in an effective way that doesn't distort competition is a very important part of the conversation we're having with the government. But yes, there will be a different agenda going forward, but certainly expect something on the transition to low carbon.
I mean, all I can say is fantastic, and thanks for joining us on this podcast. I mean, I've personally found it very insightful in the areas they covered. I mean, there's a lot going on, as you know, with obviously what's happening and the impact from the downturn of new vehicles and the challenges facing the new vehicle market on finance and income for the retailers and the sector. Used cars is obviously the area of focus, and we saw what happened in Q1, Q2 of used car transactions and obviously the balance of supply and demand and the conversations taking place around values at the minute of the used car market. But again, it'd be great to get you back on in the future as we sort of start to see the recovery of the impact of lockdown, and just look at what that 12-month picture looks like, because obviously we're trying to compare year to date when we've missed a good few months of the year, haven't we, in activity, and we've lost over 500,000 new car registrations and lost a number of used car transactions. So just remains to say thanks for coming on today, and it's been very insightful and much appreciated.
Thanks very much. It's a pleasure.
Well, thank you very much, Adrian, for what was a timely update on how finance sales are performing now and what we can expect to see over the coming months. So many thanks for that. Unfortunately, that's all we have time for now. You've been listening to this special Motor Trade Radio podcast brought to you in association with eBay Motors Group. Please like and share on social media, as it's important during these times for the dealer community to work together and share experiences and best practices. Many thanks to you for listening and supporting the podcast. Philip and I will be back with the industry headlines on Saturday. Until then, stay safe and stay well.